Ken McElroy, you are one of the biggest real estate investors in the country, so you're the perfect person to ask this question to. I just saw this chart this morning that was showing that the price of a home in the US versus the average income is kind of at an all-time high. When I spoke to you 6 months ago, you said you were looking for buying opportunities.
Yep.
So I'm curious what you're seeing now and kind of where we're at.
I love that chart. And I'll tell you why, because it depends on what side of the equation if you're on. If you're on the single family side, you're not cash flowing. You're not buying any of those for cash flow, right? Because the price of homes are high and the price of the mortgage is high. And the rent just doesn't pay for all of that. So what that's really doing is it's pushing people over to the apartments and the multifamily side. So we have an affordability issue, right? Because most people that are investing in single family homes are trying to get my renters, right? To rent them, right? Same thing with a home builder. Home builder's trying to get them to buy a house. So when the single family market is frothy, let's say, that's actually bodes well for rental side of the house. And so, we've seen a little bit of softness on single family. Sure. But it's still so far off. The average rent's, let's say, $2,000. The average mortgage plus all the expenses are in the fours, right? There's a big gap still. So we're still pretty good. So we're buying multifamily.
You are buying multifamily?
Yeah, a lot of it.
And so are you buying now because you just want to make sure you lock in those properties and somebody else doesn't get them? Or are you buying them because you think this is the bottom and
I don't know if it's quite the bottom.
Okay.
It could slide a little bit more, but here's what happens when big money, Wall Street comes in, they start pushing prices up.
Yeah.
When there's a lot of money chasing, few deals. So I'm trying to, be like the speedboat. They're the cruise ship, they move slow.
Yeah.
But really strategically, where I see it all coming, but they never are the first to the dance, ever, right? So they need guys like us to go do stuff and kind of prove the market out, and then they come in, and then it's gonna be really hard to compete against them, right? Yeah. So we've done 4 recaps so far. We'll do 2 more recapitalizations of our own deal with a big equity group. We bought $250 million so far of existing, and we're breaking ground on another $200 million on multifamily. That will open in 2027. So we have a bunch of strategies going. We're real busy.
Well, so obviously interest rates play a huge deal in real estate, right? And you know more about real estate than I ever will, but I follow interest rates pretty closely. I'm going to tell you what I think of interest rates, but I'd love to get your take because, again, I think it influences everything. But the reason I'm not quite comfortable with real estate, and I'm not saying I'm bearish, but I also just not sure I'm bullish. And the reason I struggle with it is my view on interest rates is that they're probably staying here or going higher unless they crash lower in some kind of a deflationary scenario. And in that deflationary scenario, then I would imagine that real estate prices get a little bit softer as well. If that doesn't happen and interest rates stay here or go higher, then it doesn't necessarily mean that we're going to have a fall in real estate prices. So,
Right. Yep. So I don't know where real estate interest rates are going. But I will tell you what we've just been doing.
Okay.
So on our last deal, we did a rate buy down agency, so Fannie and Freddie, at 5.18. At that rate, we're in the money. We're cash flowing.
Okay.
And so every deal we bought this year, we like to buy fixed if we can. Doesn't always work, but that's what we like to do. You can't do that on construction. But so we're seeing rates in the low to mid 5s. And if it cash flows today and we're buying under replacement cost, we think that's a good deal for a few reasons. One, again, I don't know if rates are going to go down below that or not. But if they cash flow today for me and I'm buying below replacement costs and I see the affordability issue still coming, and I think we're moving toward a renter nation. Personally, I don't think there's a lot of people that can afford houses. Yeah. So that's going to continue to pour people over into my sector. That will push things up. The other thing is when the big money comes in, the institutions, that'll create a little bit of a bubble. And so what I'm anticipating is if nothing changes, I'm good. I just got to keep the things at 92% occupied, and I can clip away at a very fine coupon. if things change, if rates go up, I'm still good because I'm fixed. If they go down, then I can refinance. As the inflation starts to kick in from the tariffs, somebody's got to pay for those tariffs. We don't know how much or anything like that. I do believe that real estate prices will go up as a result of that replacement costs and stuff like that. But it will really affect the supply that would typically hit. Like there's no supply. Like people pulled back when rates went up. So what I'm anticipating is the frothiness of the real estate market, the rental market is going to kind of be over by the end of 26. And then 27, it'll start to settle out and we'll start to see gradual rent growth. And then we should see really exponential rent growth. So 27, 28, 29, all the tenants are gonna be up in arms, all the politicians, rent control, all that stuff will start to kick in. So I'm really thinking of 4 years out. And so that's why I'm buying today these below replacement costs at fixed, make sure they cash flow. And then to your point, whatever happens, happens. I'm hedged on the up and I'll take advantage on the down.
I would imagine that, someone who invests in multifamily home or single family home, as a rental property, you're competing with the home builders who are trying to sell them, right?
Yeah.
So what are some of the tricks that each side tries to do to lure the customer to that side versus the other?
So the home builder, Lennar just came out with their filings last week, and it's not good. Like, their net, call it their net, which means their price of their home plus all the sales costs. So they've been putting inside of their marketing and sales costs the rate buy downs. So let's say you want to buy a home from Lennar, and you put a huge chunk of money in, because really what's going to make you not buy a home? The monthly payment. Yeah. Right. And so call it the 6-7%, money that's out there for a single family, they've got to buy that down so that they can compete. So it's showing up in their filings. So it's very interesting to see. Home prices haven't really jacked down too much. So if you own a home next to a Lennar community, you're at a huge disadvantage if you try to sell yours, right, around the same price, because they've got the big marketing dollars to buy down rates. Now you can do that too, but it's that's what's happening. So there is a bit of an adjustment going on, and I think there's not enough buyers for the amount of sellers, and so we're starting to see that now, which is actually good, Brett. Like, this actually is what the market needs. I mean, most people think I want everything to go like this or home price. That's not good. It's not healthy. It doesn't provide that entry level house for that person, like my kids, your kids. When your son gets out of school, he's going to want to buy something, and frustrates me that the price point is $400,000-$500,000. At 7%. So. Not like us. I mean, So I think that now, does that disrupt my business? It does, right? Because now it's starting to be, you can have a choice. But that's not where we are today. The price of a home has to come way down. The interest rate also has to come down. Don't know if it will. But meanwhile, rents are way below mortgage plus costs. So I think right now we have this little window for a while under this administration. And Trump's a real estate guy, whether you like him or you don't like him, right? He's cut his teeth on that the whole time. So, we're going to see bonus depreciation come back, it looks like, and he's going to preserve all the carried interest and the depreciation stuff that, real estate investors get. So I would imagine, plus he's doing stuff with opportunity zones, and he's talking about opening up some of that federal land. That all has lag, right? So all that stuff's lag. So let's say he does open up some of that federal land and people start to build on it. You're not going to see that for years, right? Right. So whatever I'm doing today, I'm exiting, as it starts to get, so it's just like anything else, but I'm playing probably a 3 to 5 year window on this stuff right now. And that's essentially what I'm trying to do, is get into the game now before the institutions. And then who knows what's going to happen with all this other stuff.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So I've got one other question. This is the one I'm really interested
Yeah.
in. So when we were speaking one time, I can't remember if it was 6 months ago, a year ago, you mentioned to me that your international buyers will typically come in and invest with you when the dollar is weaker because their currency is stronger, right? Well, so now we have the dollar's gotten weaker this year, but it's part of the reason that it's gotten weaker is because the theory is that people are pulling capital away from the United States. So I'm curious if you are seeing any international buyers coming in, or what's your view on that?
It's very different today.
Yeah.
So you're right. So in 2007, I was raising money out of Canada. And the dollar was almost equal. I think it was September of 2007, the US dollar and the Canadian dollar were almost equal, which is, doesn't happen very often, right? And that's because of our weak dollar, not necessarily because they're a strong dollar, as you know. So today it's very different where they're like, we don't trust the US dollar, right?
Yeah.
And they're like, with all the stuff happening here, so there's a pullback. So we're not seeing the international inflow like we were certainly back in 07, 08, 09. And I got a tremendous amount of money that came from out of the country during that time trying to chase goods and services and hard assets and stuff because they were not happy with their situation, right? So there's obviously a lot that goes into this, but this is a very different time. We're seeing a flight to like gold and Bitcoin and stuff like that instead of U.S. real estate, right? So, so not like before.
It would be interesting to see how it goes from here. There's just so many variables up in the air right now. It's probably the most uncertain time that I've seen in doing this for 25 years, and so we'll see where it goes from here.
It's wild. Yeah, it's fun too.
Well, I've used 2022 as my analog for 2025. When we came into 2022, it was a wholesale regime change based on interest rates. People had been in business for 40 years and had never seen interest rates, go up significantly.
Yeah.
I mean, they were going down, right?
Yeah.
And so it took 6 to 9 months for the market to kind of come to grips with interest rates ratcheting higher rather than lower. And during that first 6 to 9 months, it was very volatile. And so I thought 2025 would be similar. And so far it has been, because I feel like we're having a regime change now, but now it's based on how the US does business with the rest of the world, and it's based on tariffs rather than interest rates. The fundamentally interesting thing to me is that both interest rate hikes and tariffs kind of have the same effect on the economy. It's costing more, right? And so we had the big sell-off in April. We've seen a big rebound. It's a rebound. I thought it would rebound. I didn't think it would quite rebound quite this high, but I would expect in Q3 we have more volatility similar to what we saw at the end of Q1.
I think what you're going to see is the second half of this year is going to see the single family market, come down, prices come down. What you're going to have is it's it's really about normal. And by the way, my whole career was built on what interest rates are today.
Yeah.
Like my whole career.
Yeah, right.
Right.
Sure.
I just had this little window that everyone kind of came in at. They thought, oh, this is the way it's supposed to be. That was a gift for a while. Now, it could go back there, but if you can't make a real estate deal at 5% to 6%, it's probably the wrong deal.
Historically, they're really not that high, right?
Right.
Yeah.
That's the thing that a lot of people, and so everybody's like hanging on these quarter point or half point adjustments, and they're important, don't get me wrong. But the real issue we have in the single family market is we have, I think, over 60% of the people are sitting on trapped equity with low interest rates.
Yeah.
And they're, if they even move laterally, it's a bad decision, right? They can't even move to their neighbor next door at the same price because their payment's going to be a couple thousand more per month.
Well, that's what's kind of interesting to me is I feel like the prices are kind of back to where they were pre-global financial crisis, right? But then it was because people were buying multiple homes and there was tons of liquidity. Now it's kind of the same thing, but people are trapped in their one home and they have tons of equity, but they're kind of trapped because they can't move and they can't refinance.
Right. I would suspect that you're going to start to see financial products that says, okay, Brent, you got 300 or 400 grand in your home. You can keep your mortgage and we're going to give you this opportunity to pull that out and be a second or a third or whatever it might be. That would, because everybody's looking at that. That's trillions of dollars. And when that actually needs to open up and flow, the problem is that's all sitting in 4% or less. Right? Like my wife, Danielle, has a condo that she wants to sell. And it's actually doing fine, but she wants to move it into a single family home. It's at 2.85% interest rate. and she's like, she's got hundreds of thousands of dollars in equity in it and she wants to turn it, but she's like, I just can't leave the loan. And I think a lot of people are in that scenario where their payments are low. She cash flows because the rents are, actually rents aren't really going up a lot, but her rate is so low that she cash flows quite a bit every month on that property. So she can't move it because of the rate. So the rate today is really an asset, right? If you have a loan in the 2, 3, 4%, it's an asset. And you just don't want to move off of that. And so there's a lot of that happening. And so if rates do come down, it'll unleash all that equity and, and that actually would be good. It will create another bubble. But if they stay the same, what you'll see is a lot of people will stay put for a long time. And what will happen is, this happened before, I've seen this, if let's say you live in a house and you've been there now 8 or 9 years, and now all of a sudden you go to Home Depot, you go to Lowe's, and you start to see their stocks go up because they're like, we need a new refrigerator, we need this, and we need cabinets. And so they start to do these home equity HELOC stuff, kind of harvesting the money inside of the equity, but they don't move because they have such a good low mortgage. And so really that kind of renovation platform starts to really, really make sense for a lot of folks. So it'll be interesting to see how long they stay.
Do you have an opinion on Fannie and Freddie, about the government potentially bringing them out?
Yeah, I know, not a strong one. They've been fantastic for us. I don't know the inner workings, but for us, it's really, really good debt. It's, however, under 60% loan to value today. But we've had a phenomenal history with both Fannie and Freddie. So for me, it's not broken. You know what I mean? Don't touch it. But doesn't mean that they won't.